Today I want to go over with you how I swing trade shares, and I want to show you what I look for to identify a position, how I get into that position, and where I would set my stop losses at to get me out of the position. And this strategy can be great if you don't have time to sit in front of the screens all day and monitor these trades. If you got a busy life, a full-time job, whatever, once this trade is planned out, you can just kind of let it go in the background, keep an eye on it every now and then, and basically let the market tell you when it's time to exit the trade. So let's take a look at the charts and get right into it. So when it comes to swinging shares, I'm primarily a trend trader. So what I have up is 3 different time frames. I have the weekly, the daily, and the 30-minute. And I'll go down through a list of stocks usually every Sunday night, and I will just scan through them quickly looking for anything that catches my eye. Usually the highest probability setups come from trend alignment. So if you have an uptrend on the weekly, an uptrend on the daily, and an uptrend on the short term, you're going to have a very high probability setup as long as you have a good entry on it. And when I say uptrend, I just simply mean higher lows and higher highs, which you can see on all of these time frames. Once I find a stock that looks interesting to me and is near a level of interest, I will then add it to a separate watch list, which I can go down through every day and pay attention to more closely. Now, when I say level of interest, that is probably the most important part of this trade setup, because I don't just randomly enter in a stock, even if it is trending. It's got to be near at a level of interest for me. And usually where I try to identify these is on the daily time frame. So you can see on the daily chart, a level of interest could be a 150 moving average, a 200 moving average. It could be this trend line support area. It could be anchored VWAP, or just somewhere where price has a chance to find buyers. So once price gets near a level of interest, I want to watch and see how price reacts to that level. So you can see that Google bounced on this 150 here, here, and here. And you wouldn't just want to blindly enter on any of them bounces without seeing a short-term reversal of that trend, because on this last bounce, you can see that it blew right through it, and I'll go into that in better detail. So on this most recent test of the 150 moving average here, I made a shorts video with 3 stocks that I was going to watch, and Google was one of them on this 150 MA because it had bounced 3 times prior to this. And I didn't end up entering this trade, and I'll show you why in the 30-minute chart. But you can see if you were to enter this, which I imagine a lot of people did, and had your stop below here, you would have got shooken right out. And you can see this large red candle on high volume. I would imagine a ton of people got stopped out of that trade right there. So if I go over to the 30-minute, you'll see why I didn't enter this trade. So this area right here would have been the day that price hit this 50 moving average over here. And you can see that price did rebound off of it, but we never made a new higher high. Even the next day after that, we made a higher low, but we made a lower high. So that right there would have kept me out of that trade. So this right here just goes to show exactly why you can't just blindly enter on a level of interest, even though it proved to be strong support multiple times before. Because larger players in the market might see this and purposely drive price down, trigger all retail stops, and provide themselves with liquidity before a huge move up. So when you're stopping out of your positions, you're selling into somebody who's buying at rock bottom prices. And there is still times, even if this were to make higher highs and higher lows and you got into it, it might still not work out, but it just provides a higher probability of a trade setup when you wait for the short term to resume its uptrend. So now we have price that broke through the 150 MA, and the next level of interest I had was this 200 MA. And I paid attention there to see how price reacted. Now, if price wouldn't have stopped here and kept going, my next level of interest would have been this trend line. So if we move back over to the more recent time on the 30-minute, I'll show you where I entered the trade and why I entered the trade. Okay, so now we're down to the 200 moving average, which is my next level of interest, and I want to pay attention to see how price reacts there. Now, if we look at the 30-minute, you can see that price started stalling out a little bit and came down and made a bottom right here. Now, we don't know that's the bottom yet until we see a higher high and a higher low. So price comes up, makes that higher high, higher low, higher high, and this is when I seen the trade. So on this day, price came back down, and this was the night that I was paying attention to the stock. So I told myself, if price opens and gets back above the close of this day, I will enter this trade. So the next morning, price came out of the gate strong, and I got in the trade right here at 135.79. Now, like I said before, if I'm trend trading an uptrend, where do I want to put my stop? Well, if the definition of an uptrend is higher highs and higher lows, I want to put my stop beneath the last higher low, which would have been right here at 133.40. And this was all planned out before I entered the trade, so I had an idea of what my risk would have been, and we're going to go over that. So like I said, the night before, I already had planned this trade out, and I knew where my stop was going to be. So then you have to ask yourself, how much money do you want to risk on the trade? So how I figured this out is the night before, I'm just estimating where my entry is going to be. So if we were to take a calculator and say I'm getting in at 135.79 and stopping out at 133.40, I'm risking $2.39 per share. So then you got to ask yourself, how much capital am I willing to risk on this trade as a whole? So for me, I only risk 250 on this trade. So I take 250 and divide that by 239. And that gives me 104 shares, which I just kept it a whole round number. So I entered this trade with 100 shares. So now you want to see how much capital this trade's going to take to enter. Since I'm entering with 100 shares, it's easy math. At 135.79, it's going to take $13,579 to enter this position. Normally my full risk size is about $2,000, so if I wanted to risk $2,000 on this trade, I would have took that divided by 239, and that would have gave me about 800 shares to enter with. So if I take 800 shares times 135.79, it would cost $108,000 to get into that position. Now with the market currently at all-time highs and a bit overextended, we also have FOMC coming up. I've been sizing all my positions down and just being a little extra cautious lately. And even if I wasn't, that is too big of one position for me to enter. I would not just enter a single position with $108,000, especially if I was going to hold it overnight. Because if something were to happen and this stock gaps down overnight and say it drops 10%, well, you're going to wake up in the morning and have a $10,000, $11,000 loss on this trade. So risk amount and position sizing is an important thing to consider, especially if you're holding overnight. Now, if you're just day trading, I'm comfortable entering much larger positions like this because I can get in and out of the stock. There's liquidity. But overnight, you may not be able to get out of this if it's not a stock that trades after hours, and your stop loss will not trigger. So now getting back to the trade, once I'm in the trade, the first thing I do is mark on my charts my entry and my stop, just so I have a visual when I'm monitoring the trade. I can see where I'm at. The other thing I do is I put my 2R on the chart as well, which is just simply if I'm risking 1 right here, then this would be double the reward of what I'm risking. So I just put that on my chart because a lot of the times, as soon as price gets up to here, I might trim a third or 50% of my position depending on how price action is looking. And on this trade, I did exit 50% up at 2R. And that just locks in some gains just in case something happens and it wants to reverse on me. You never know, and I've given back profits too many times. So now, as price keeps moving up and going higher and higher, I'm adjusting my stop loss accordingly. So once price gets up so high, makes a new higher high and higher low, I'll move my stop up to protect more capital, because if this trend were to break, then it's going against my original thesis. So keeps coming up, I move my stop up. It keeps coming up, I'll move my stop up to here. So you can see on this day here, we had a huge gap up overnight. And this was due to the Apple and Google news coming out that Google and Apple were going to work together on AI. So that next morning I did happen to be working in the office and I was paying attention to this position. So I was watching the tape and I was paying attention to the momentum and volume, and right up here I could see momentum starting to fade out. So I exited another 25 shares up at 151.01. So I paid attention to the position a little bit longer, and I seen that it couldn't find any more buyers. It already went up over 5%. So I got out of the rest of the trade at 149.75. Now if we keep scrolling and look at the chart here, now could I have left my stop down here and keep riding these higher highs and higher lows? Absolutely, but after a 5% move like this, you know, I'm looking to just take my profits. I'm already way above my 2R. It was an excellent trade. And if you look at the daily, this thing just shot up with no real meaningful pullbacks and is just, you know, we're overextended on the stochastics right now. The MACD's, you know, has a lot of momentum. At this point, I'm just looking to get out. I've given back profits one too many times. And for me, you know, I could always get back into this trade if I wanted to. Another thing was FOMC was coming up the next week, I think it was. So, you know, the market can move big on that news, and it just wasn't worth the risk anymore. It was a good trade, and I don't want to get too greedy with it. Let's take a look at the trading journal and break this trade down a little bit further. So you can see I had a $981 profit on the trade. It costed $13.5 to get into it. I had 3 different exits, and when I'm looking for these trade setups on this strategy in particular, I'm looking for at least a 2-to-1 risk to reward. So if I'm risking $250, I want to look at the chart and see if the stock can at least, you know, have a potential of getting to 2R, which would be a $500 reward on the trade. So rounding it to 100 shares, you can see that my actual risk was $239. And so my profit aim would have been $478 for a 2R. And if we look up at the top here, my expectancy is that 2R, and my actual R multiple is a 4.1. So in my books, that's a perfect trade. You know, I was very happy with it. Now, obviously, looking back, you could look at this and say, you know, I wish I would have entered it with full size. So say I had my $2,000 risk times our actual R multiple. That would have been an $8,200 trade, but you know, it could have just as easily went against you. You know, the market to me feels a little bit top heavy. So I'm just taking a little extra caution. I'm still in bullish trades. I know I made that video on the SPY might be near its top. That wasn't saying, oh, I'm going short everything or I'm a bear. That's just an indication for me to be a little bit extra cautious and monitor my bullish trades more closely. Because when this thing does turn over, and it eventually will, I don't want to be caught up with 10 trades at full sizing and experience a huge $10, $15, $20,000 drawdown in my portfolio. So I guess it just comes from previous experience. You know, that did happen to me, especially back in 2022 in the bear market. I had a ton of bullish positions open and I experienced a massive drawdown, and it took a long time to recover from that. So I'm just a little extra cautious these days, and I pay attention when the market is super overextended. Another thing I want to say about swing trading shares like this is be very cautious in what stocks you're choosing to do this with. If you're going to hold this position overnight, you probably want to stay away from volatile stocks that tend to gap a lot, because if this thing gaps down overnight 10-15% like a pharmaceutical or you know, a very volatile stock like say Rivian or DWAC or something like that could, you know, your stop loss will not trigger after hours. And even if you can trade that stock after hours, there might not be enough liquidity for you to get out of your position. So if it gaps down 10%, 20% overnight, you could wake up with a huge drawdown even though you only planned on risking say $250 or $500 in that trade. So that's one thing to consider. The one thing that I do to try to help with this is I'll set an alert with my stop loss. So at least if the stock does go down after hours, my alert will go off. I'll pull it up, monitor the trade, If it's a stock that trades after hours, I'll try to just get out of it. But if it's a stock that doesn't trade, you're just going to have to wait till the morning. Or if you're in a huge position, there might not be enough liquidity for you to get out of that trade. So it's just something to keep in mind. It is a risk of holding shares overnight. And, I don't worry about this when I'm day trading a stock, but I'm busy and I don't have the time to day trade. So I try to find strategies that allow me to get in a position and hold it for a few days, a few weeks, or a few months. So if you found value in this video, please consider giving it a thumbs up and subscribe to the channel if you want to see more.